And we're live, I believe. So Chairman Lee, our distinguished committee members and witnesses, welcome to everyone. Our country faces two crises, a virus that's already killed 154,000 Americans and the worst economy since the Great Depression. Our tragic failure to contain the coronavirus has led directly to this economic meltdown. The president's ill-advised push to liberate the states and abandon strict social distancing measures has led to an explosion of new cases and new deaths, and likely will prolong the deep economic downturn. The president's economic policy is his coronavirus policy, which tragically is first to put his head in the sand, then throw his hands in the air, and then blame others. That's the number one reason there are more than 65,000 new cases a day, and why there are more than 30 million Americans on unemployment. We've had the privilege of talking to many prominent economists that all tell us the same thing. To restore the economy, first, we must get the virus under control. But it's not essential only to contain the virus. We must also give Americans a high degree of confidence that the virus is contained. They must know that they're safe before they'll go back to work or before they'll return to stores. Fed Chairman Powell said, until the public is confident that the disease is contained, a full recovery is unlikely. And the best that we in Congress can do is to give Americans confidence that we will help them stay afloat while the virus rages. And the economic damage is staggering. For 19 straight weeks, more than 1 million Americans have filed new unemployment insurance claims. We've lost a net 15 million jobs since February, and the unemployment rate is the highest it's been in 80 years. The labor market recovery is stalled. And according to the Census Pulse survey, the number of Americans employed fell by 4 million in a recent week. It's the fourth straight week the number of Americans with a job has declined. And CBO estimates that the unemployment will remain above 10% for the rest of the year. As a result, nearly 1 in 5 American households cannot make their rent or mortgage payments in July. Millions stand in line at food banks. 40% of Americans report serious anxiety or stress. In March, Congress passed emergency enhanced unemployment benefits to help Americans survive the coronavirus recession, enough to live on. 30 million Americans receive those benefits. The Democratic House voted 2 months ago to extend them, but Mitch McConnell's refused even to consider the HEROES Act, knowing that millions of Americans who rely on those benefits live in uncertainty and fear. And tomorrow, thanks to McConnell, those unemployment benefits expire. And this will have ripple effects throughout the economy. Without benefits, jobless workers will reduce spending, miss rent payments, fall behind on mortgage payments, and even face eviction or foreclosure. More businesses will close. The Economic Policy Institute estimates that reducing the weekly federal benefit from $600 to $200, as some Republicans proposed, would reduce GDP by 2.5% and cost the economy 3.4 million jobs over the next year. That's more than the total economic growth in 2019. But there's a simple solution to this damaging brinkmanship. Let's just take politics out of it. Our Democratic witnesses, Heather Boucher and Jared Bernstein, as well as other of the nation's top economists, support the use of automatic stabilizers that tie federal spending to economic conditions. They quickly provide help when the economy heads into recession. If unemployment is elevated, unemployment insurance, along with SNAP, Medicaid, and other key supports, should continue until the economy recovers. We shouldn't have to vote 13 times, as we did during the Great Recession, to extend unemployment benefits. This should be automatic. And it should only last as long as it's needed and no longer. And I believe this approach would appeal to fiscal conservatives. Yesterday, I introduced legislation to tie unemployment benefits to the unemployment rate in each state. If the bill were to become law, we wouldn't be witnessing this damaging political showdown today. None of us can predict how long the recession will last, so let's not try to guess. It's very likely that whatever agreement Congress eventually agrees upon won't include my bill, and that's because the political power of some members of Congress depends on holding Americans hostage. But we have to reach an agreement to extend enhanced employee benefits at some level. This is a moral imperative. And I'll fight to make sure there's enough for unemployed Americans to weather the recession, and I'll continue to fight to make sure that in the future, such help is automatic. I look forward to the testimony from our witnesses. I'm happy to yield to the chairman of our Joint Economic Committee, Senator Lee.
Thank you very much, Vice Chair Bleier, and thanks for presiding. today for the first time as vice chair over this timely hearing.
Senator Lee, are, are you still there? I believe Senator Lee has disappeared for the moment. Can anyone else hear him? Okay. Why don't we come back to Senator Lee, and while he's struggling with broadband in Washington, D.C., let me introduce our four distinguished witnesses, and we will defer back to our chairman as soon as he arrives. So we start with Heather Boucher, the president and CEO and the co-founder of the Washington Center for Equitable Growth. Her research focuses on the intersection between economic inequality, growth, and public policy. Dr. Boucher is the author of Unbound, How Inequality Constricts Our Economy and What We Can Do About It. She co-edited Recession Ready, Fiscal Policies to Stabilize the American Economy, published jointly by the Washington Center for Equitable Growth and the Hamilton Project. Previously, Dr. Boucher worked as an economist in several organizations, including the Center for American Progress, the Economic Policy Institute, and the Joint Economic Committee. She received her PhD in economics from the New School for Social Research. Jared Bernstein, let me yield back to Senator Lee.
Thank you. Thank you very much. Sorry, I lost my internet connection somehow. So this pandemic and the havoc that it has wreaked on American lives and on the American economy is unlike anything we've seen, certainly in recent memory. In response to the pandemic, Congress has taken unprecedented action that, along with Federal Reserve initiatives, helped to stabilize the economy and helped make sure that it didn't hit us too hard too quickly. Beyond the legislative changes that we enacted, existing features of the tax code and traditional safety net programs like unemployment insurance are helping families that lose income and jobs to the pandemic as the pandemic ravages our communities. Known as automatic stabilizers, these policy provisions operate automatically and simultaneously with other actions taken by states and by local governments and by Congress. But it concerns me that many want to extend the economic automatic stabilizers, as that would override the deliberation that the American people have come to expect of their representatives, their elected officials who are in place to make law. And that in turn could hinder the economic recovery, in addition to weakening our constitutional framework of our limited government system. So mandating more spending in the form of automatic stabilizers, stabilizers that turn on and off based on macroeconomic conditions in real time as they arise, contributes, I fear, to one of the main problems of federal spending. That federal spending is overly automated, causing legislators to actively manage less and less of the budget, less and less of the federal outlays as time moves on. Reducing legislative discretion, taking the discretionary authority and the decision-making power away from Congress increases costs, and it reduces our ability to control the national debt. It also diminishes policymakers' ability to tailor responses to the specific conditions of any future crises that might happen. These things tend inevitably, ultimately, to diminish accountability of government to the American people. The extraordinary measures we enacted initially were warranted, but they're not strategies that we should necessarily continue to pursue now. Certainly not without some hesitation, certainly not without asking some questions about their advisability. These are unsustainable over the indefinite course of the current pandemic. And today, I think we have to pivot to helping communities reopen safely. So our focus moving forward should be on policies that pave the way for an American recovery and to allow businesses to adapt and reopen safely and as quickly as possible, while at the same time giving their employees and their customers and other members of the public confidence in the procedures that are in place. There are a number of actions that Congress could take to strengthen the U.S. economy while we're going through this, and in the process of doing so, hasten our economic recovery. We should examine, and I think we ought to remove the regulations currently in place that are holding back businesses and workers from responding more dynamically to challenging and ever-changing economic circumstances. And we should consider how Congress can encourage Americans to save more so that they can be better prepared for future crises. Just as this is not the first crisis our country has faced, it's also not going to be the last. And the healthier we are economically and in every other way, the better prepared we can be to handle the next crisis as it arises. Our efforts should include leveraging charitable giving by reforming our tax laws and specifically reforming the inequitable treatment given to charitable contributions in our existing tax code. This is a reform that could bolster our COVID-19 response, as we discussed in our last hearing. We have to remember that our safety net consists of three levels. You've got families, you've got charitable organizations, and you've got governments. Charitable organizations are in the middle of those two. They're very important. And in a global pandemic like this one, you see them stretched thin at both ends, just as the demand for their services is higher than ever during something like a global pandemic. You've also got people less inclined and less able to donate in such a time, especially from people in the middle and the lower ends of the economic scale. Our efforts should also include sunsetting all federal regulations that were waived during the pandemic. In a letter to the recently confirmed director of the Office of Management and Budget, Russ Vought, several of my Senate colleagues and I asked that these waived regulations go through the regulatory review process. That is, before they can be put in again, we ought to review them to figure out whether they still make sense. This process would determine whether we need to maintain these regulations, whether we need to modify them, or whether we need to rescind them. Now, we noted in our letter the absence of the waived regulations, that the absence of these waived regulations being implemented actually improved our COVID-19 response efforts and also allowed doctors to practice medicine across state lines and to provide telehealth services for Medicare patients. This resulted in better patient outcomes, it resulted in cost savings, and it resulted in a suppression of activities that would otherwise have likely led to more COVID-19 exposure. So all those things are good. We ought to consider them for the longer term. Now also seems like a particularly good time to pass the Working Families Flexibility Act, which would allow more employers to offer their own workers a choice between overtime pay on the one hand and time off, paid time off on the other hand. This could help workers take time off if they become ill or if they need to care for loved ones, while also giving employers yet another tool to help weather these nasty, disruptive effects associated with the pandemic on payrolls and on worker schedules. But look, whatever actions we might take, we need to not lose faith in our ability as a deliberative body, both in the Senate and in the House of Representatives, to represent our respective constituents and to consider and evaluate, debate, and improve various policy solutions tailored to the crisis that our country faces at this moment and in future moments. And we have to remember that policy should support the resiliency of the American people in the face of adversity, rather than making them more dependent on government. So thanks again, Vice Chair Boucher, for calling this important hearing. And thanks to the witnesses for being here today. I look forward to your testimony and to a worthwhile discussion.
Thank you, Chairman Lee, very much. And I look forward to working with you together on the charitable deduction issue. Let me continue with the introductions. Jared Bernstein is a senior fellow At the Center on Budget and Policy Priorities, he was chief economist and economic advisor to Vice President Joe Biden from 2009 to 2011. And before joining the Obama administration, he was a senior economist and director of the Living Standards Program at the Economic Policy Institute. Dr. Bernstein is the author and co-author of numerous books for both popular and academic audiences, including Getting Back to Full Employment, A Better Bargain for Working People. He holds a PhD in social welfare from Columbia University. Dr. Douglas Holtz-Eakin is the president of the American Action Forum, which he founded in 2009. Previously, he served as director of the Nonpartisan Congressional Budget Office and as chief economist for the Council of Economic Advisors. Dr. Holtz-Eakin spent more than a decade at Syracuse University, where he was trustee professor of economics at the Maxwell School, and he holds a PhD in economics from Princeton University. And finally, Rachel Gressler is a research fellow in economics, budget, and entitlements at the Heritage Foundation. Her work focuses on policies that promote economic growth, individual freedom, and well-being. Ms. Gressler's writing and research includes analysis of Social Security and its disability insurance program, public and private sector pensions, and labor market policies such as the minimum wage and paid family leave. Before joining Heritage in 2013, Ms. Gressler was a senior economist on the staff of the Joint Economic Committee. She holds master's degrees in economics and public policy from Georgetown University and a bachelor's degree in economics from the University of Mary Washington, one of my favorite Virginia universities. So welcome all of you today. We're thrilled to have you. And we'll begin with Dr. Boucher. The floor is yours.
Wonderful. Thank you, Vice Chair Boucher and Chairman Lee, for inviting me to speak with you all today. It's a real honor to be here. My name is Heather Boucher, and I am President and CEO of the Washington Center for Equitable Growth. We seek to advance evidence-backed ideas and policies that promote strong, stable, and broad-based economic growth. Our research shows that economic inequality systemically obstructs and subverts the pathways to growth, creating distortions in both investment and consumption. The economic uncertainty facing your constituents and our nation is, when will the administration and Congress address the COVID-19 pandemic? Addressing the administration's failure to contain the virus is the only way to restore confidence and put us on the path to economic recovery. The United States is experiencing the most uncontrolled and deadly outbreak of any high-income country in the world. Compared to the European Union, we now record 10 times as many daily COVID cases and deaths. This failure is the result of a series of decisions made by the administration. But it is also the result of decisions made over the past 50 years that have created underlying fragilities in our economy and our society. These decisions have made our economy less effective in good times and less resilient to shocks. We've put ideology over evidence. We have chosen tax cuts and deregulation over investments like paid family leave, robust social insurance, and public institutions. We have put our faith in the idea that markets can do the work of governing. Our neglected unemployment insurance system has been unable to handle the millions of Americans losing their jobs. Millions have waited weeks or months as decades-old computer systems struggle to process claims. Now, the emergency unemployment has effectively expired because for months the Senate has refused to act. We have no nationwide system to contact trace confirmed COVID cases, and months into the pandemic, COVID tests for the general population can take a week or more to process, and access too often varies by race. What is uncertain is whether the Senate will renew the $600 increase in weekly unemployment benefits that have been allowed to effectively expire. Over 11% of the workforce is unemployed. The unemployment rate for Black Americans is over 15% and over 14% for Latinos. We risk a cascade of potentially uncontainable economic damage if you do not immediately act to extend high unemployment benefits. Families need this money. Their landlords need this money. They need them to pay their rent. Their local business owners need them to keep ordering takeout and popping by for socially distanced shopping. Like the virus out of control, high unemployment spreads economic pain throughout the entire community. Unemployment benefits accounted for 14.6% of all wage and salary income in May. Failure to extend the $600 boost would contract GDP by 2.5% in the second half of this year, more than the economy grew in 2019. That would devastate local economies. In states where unemployment benefits replace a greater percent of workers' wages have had the strongest recovery as of early June. Enhanced benefits should only end when objective conditions show they are no longer needed. An unemployment rate-based trigger that turns off when a stable recovery is underway would allow this program to wind down automatically. The Vice Chair has a bill to do just that. The second priority, to create certainty, is to support states and localities with aid around the $900 billion in the HEROES Act. They are bearing the brunt of responding to this virus. They are losing tax revenue, and as a result, have shed 1.5 million jobs so far, even as their services are more necessary than ever. Other priorities include food assistance, rental assistance, an extension of the eviction moratorium, direct payments, investments in communities of color hit so hard by the virus, funding to ensure safe and secure elections in early November, and premium pay to our essential workers. You should also implement the data tools to tell how the recovery is distributed up and down the income ladder. The GDP 2.0 measure, which we have discussed here before, will tell us if families are recovering from the crisis and which need more help. And I urge you, do not support a bill with enhanced liability protections for big corporations facing lawsuits if they put their workers at risk. Markets cannot perform the work of government. Americans need public institutions that can protect them from threats to their lives and livelihoods and provide leadership in times of crisis. Thank you. I look forward to your questions.
Dr. Boucher, thank you very much. And we appreciate it. We'll move on to Dr. Bernstein.
Well, thank you, Vice Chair Byer and Chairman Lee, for the opportunity to testify before you today. The U.S. economy is in a precarious place. We learned this morning that the GDP contracted at the fastest rate on record in the last quarter, a 33% annualized rate. Investments in homes and businesses fell by half. These nightmarish numbers need context, however. They reflect the economy falling off a cliff in April, partially reviving in May and June as local economies across America began to reopen. It is clear, however, that these reopenings came too soon with far too little attention paid to controlling the coronavirus. Today, because of the ongoing failure to control the spread of the virus, tens of millions of Americans continue to experience severe disruptions to their lives and their living standards. New evidence, which is more recent than last quarter, shows that many now risk hunger and eviction. Over 30 million people, that's about a fifth of the current labor force, claimed unemployment benefits in recent weeks. And as members of this committee well know, they all face a potentially huge negative shock to their income should their enhanced benefits expire tomorrow. In this regard, one of the key points of my testimony today is that while we can and should have a good debate about their levels, allowing these enhanced benefits to expire represents a failure on top of a failure. Leadership has failed to control the spread of the virus, and after initially strong fiscal actions, for which I give Congress credit, is now failing to help economically vulnerable Americans cope with the fallout from the failure to control the virus. Congressional majorities appear to agree with the need to extend enhanced benefits. The bad news is that debate over the issue started too late to avoid expiration. It's also of great concern that a Republican proposal in the new HEALS Act, cutting the 600 weekly plus up to 200 and then requiring states to hit a 70% replacement rate, represents a large benefit cut to something like 25 million jobless persons and their families at a time when the economy and job market are clearly weakening. On average, this cut 600 to 200 would lower weekly benefits by over 40%. In Utah, Chairman Lee, average benefits would fall 42%. In Virginia, Vice Chair Byer, they would fall 47%. Small businesses are closing at an accelerated rate. Business bankruptcies are up 26% from a year ago. And a whopping, this is my first figure actually, a whopping 80% of the US population lives in places where economic activity is once again retrenching due to the spread of the coronavirus. Up to the minute labor market indicators suggest there's a fair chance that after strong job growth in May and June, payrolls in July may have contracted on net. These unsettling trends are shaking the confidence of American businesses and households while leading to great uncertainty about what the future holds. Furloughed employees worry about transitioning to the ranks of the permanently unemployed. Working parents with young children are fraught with uncertainty about school restarting in the fall, wondering what sort of childcare arrangement they'll need if schools remain even partially shut down. Businesses, large and small, are unable to reliably forecast revenues, invest in the future, or even know if they can make it for another month. State and local governments are facing their largest shortfall in years, leading to job losses and great uncertainty regarding their outlook. And whatever burdens Americans face on average, they are far more significant for persons of color who have disproportionately been hit by both the virus and its economic impact. Congress must do all it can to reduce this uncertainty and give the American people reason to believe that the federal government is their reliable partner. They need to see that members of this body will work together with the requisite urgency to help them and their families and their businesses make it through to the other side of this crisis. We should discuss and debate the most helpful way to get there. I understand and respect that others are going to have different ideas, but what is not debatable is that the American people and the economy once again need your help, and there's no plausible reason for such help to be delayed. In fact, to do so unnecessarily boosts uncertainty, reduces confidence by consumers and businesses while prolonging the pandemic, the downturn, and avoidable human suffering. Thank you.
Dr. Bernstein, thank you very much. Now move to the testimony from Dr. Holtz-Aiken.
Vice Chair Byer, Chairman Lee, thank you for the privilege of being here today. Let me make 4 points briefly, and then I look forward to the chance to answer your questions. Point number one is that the U.S. economy entered 2020 growing strongly, and with the labor market that was displaying remarkable resiliency, creating many more jobs than I at least thought possible this late in the recovery. It was drawing into work those who had been marginally attached to the labor force, those with the least skills, least experience, and it was that part of the labor market that was achieving the greatest wage gains. This was an enormous help to communities of color and to others who had been isolated economically. That economy got hit within a downdraft of enormous historic proportions. As has been noted before, we saw second quarter GDP fall by nearly 10%, a nearly 40% annual rate. This has been accompanied by other statistics that are simply outside of the bounds of normal experience. Sustained high claims for unemployment insurance, 20 million jobs lost in the month of April alone, 10 times larger than any other single month of job loss in U.S. history. And to the credit of the Congress and the Federal Reserve, the response has been correspondingly large. When the Federal Reserve identified massive cash flow shortages in the economy and disruptions in financial markets, it flooded those markets with liquidity, expanded its balance sheet by trillions of dollars, and we have seen remarkably good functioning of financial markets through the pandemic recession thus far. Congress, with the Families First and the CARES Act, undertook an enormous fiscal expansion, nearly 10% of GDP, that provided assistance to households, provided assistance to small businesses, especially if they remain attached to their workers, provided assistance to key industries, and in my view, successfully executed a strategy that said, we will provide enough liquidity through Federal Reserve and congressional actions to wrap the economy in that liquidity, hide from the virus for 2.5 months, and then resume operations. Going forward, it is clear that we can no longer simply hide from the virus. We will have to be able to operate an economy in the presence of the virus for the foreseeable future. And figuring out the right fiscal policies in those settings, I think, requires looking at the roots of the downturn. And the key issue in the downturn is that households, without any loss in income, stopped spending. In particular, in the second quarter, 2/3 of the decline was diminished spending on services, and fully 1/3 of it was reduced spending on healthcare services. Households, especially affluent households, stopped going to restaurants, traveling, going to hotels. They stopped doing anything that involved personal interaction and the delivery of services. To have a successful strategy going forward, we cannot simply rely on income replacement in the form of checks or unemployment insurance. We've actually done a remarkable job of that already. In the second quarter, as the economy contracted by 10%, disposable personal income rose by 10%, and the saving rate exceeded 25%. To be successful, we have to somehow address the safety issues that are the Achilles heel of this economy. It has to be the case that workers are willing to go to work, businesses are willing to open their workplaces, customers feel safe conducting commerce. Those kinds of supply side considerations, the workers and the businesses, should be the focus of what the Congress does. I'm a big fan, for example, of tax credits for subsidizing the purchase of PPE, the provision of testing, the modification of workplaces, so as to be able to conduct business in the presence of the virus. That's a strategy that has to be an essential part of anything that will be successful going forward. That strategy doesn't include, in my view, automatic triggers on unemployment insurance or other such expansions of mandatory spending. From a budgetary perspective, mandatory spending is the original sin of federal budgeting. Prior to the existence of mandatory spending, we balanced the budget on average. Since it was widely adopted in the mid-60s, we rarely balanced the budget. And indeed, in the 21st century, we have never stabilized our debt relative to GDP. So we should only have additional mandatory spending programs if they're absolutely necessary. We've seen a broad discretionary response. I see no compelling case that says Congress can't respond effectively. We do have existing automatic stabilizers, as Chairman Lee pointed out. There's no reason to suspect they're failing. And the entire exercise of putting in the automatic triggers presupposes that this Congress has better information, has better judgment about the policies than a future Congress, which in my view will be much better positioned to make those same decisions. So I don't think you can make the case to give up our current system in favor of the mandatory system at this point in time. So I thank you for the chance to be here today, and I look forward to answering your questions.
Thank you, Dr. Holsaken, very much. And now we finish with Ms. Gressler. Welcome aboard.
Thank you so much for the opportunity to be here today. And along with Ms. Boucher, it's a pleasure to be back at a JEC hearing. As we talk about the shared goals of reducing uncertainty and increasing confidence, it's important to recognize that we can help Americans who are suffering economic hardships without delaying the recovery or further driving America towards fiscal collapse, potentially then leaving us unable to respond to the next crisis. One-size-fits-all government inventions come with trade-offs, especially in light of our $26 trillion debt. So it may seem amid high unemployment, struggling businesses, and general uncertainty that government programs could help, but that's often when considering only what people can get and not what they have to give up. So even some of our most basic programs are not without consequence. Food stamps reduce hunger, but they restrict what items families can buy and where they can buy them. Workers often wait a year to receive disability insurance benefits and another 2 to receive Medicare. Some workers are still waiting to receive the unemployment benefits from the CARES Act, and some businesses have thrown up their hands in confusion and frustration and returned PPP loans. Automatic adjustments are logical, but they can't always account for individual circumstances. When friends of mine suffered an income loss, their food stamps automatically increased from $700 to almost $1,000 per month. But they didn't need more food. They needed a home and a second job. When the government decides who receives what, when they receive it, and how much they receive, people have less control over their circumstances. People save less if they believe that government programs will provide for them. And they have less to spend if the government takes more in taxes to finance those programs. And already, Americans pay more in taxes than they do on food, housing, and clothing combined. It may seem like everyone would end up equally well off, paying taxes in and getting benefits out, but government programs aren't like saving accounts that households can access when they want based on what's best for them. Recent stimulus checks and increased unemployment benefits weren't helpful to the worker who had an empty bank account and lost his job when his car broke down last year. And Social Security seems like a sham to someone like my colleague who died last week at age 62 and can't pass on the hundreds of thousands of dollars he paid into the system to support his wife and his children who will soon be starting college. So it's just really hard for one-size-fits-all programs to meet the needs of 129 million very different households. I do think that those government programs can provide short-term band-aids, but lasting security and prosperity comes from households having options instead of feeling trapped. People need opportunities to earn a living. They need to achieve rising incomes and to be able to save for their future needs and desires. And responsible budgeting and planning ahead are key, but the federal government sets a terrible example here. We're told that we should have 3 to 6 months worth of expenses set aside for a rainy day. And yet, despite nearly a decade of economic growth, the federal government had zero savings and instead 62 months worth of debt going into COVID-19. We're very fortunate that we've been able to borrow to combat the pandemic, but there's a fast approaching limit to our seemingly inconsequential debt. And the danger is that we don't know the limit. Fiscal crises are often sudden and severe, leaving no room for a gradual retreat. So as calls for more aggressive federal programs intensify, Congress should instead work towards a stronger economic recovery by first replacing the $600 unemployment benefit with one that better aligns to workers' previous earnings to help unemployed workers without delaying the recovery. Second is opening doors to work. With limited jobs available, people need options, and that could include non-traditional work such as freelancing. Last year, 76% of people said that they would consider freelancing if there were a recession. And 46% of people who do freelance say it's their only option because of their own health condition or family situation. Policymakers should also support workplace flexibility. The Working Families Flexibility Act would allow low-wage workers to accumulate paid time off. And rolling back the overtime threshold would provide more stable incomes and more remote work options for lower-income workers. And finally, policymakers should enact universal savings accounts so that everyone can save in a single, simple, and flexible account for any purpose and without penalties. These accounts have been particularly helpful to lower and moderate income households in Canada and the UK. Most households would prefer to have a savings account available when they need it to spend on what they want than to have the government specify what they can get and when they can get it. Thank you, and I look forward to your questions.
Ms. Grensler, thank you very much. And thank you to all of our panelists. I'll now begin our first round of questions. Dr. Boucher, is there any evidence whatsoever that the supplemental unemployment insurance benefit, the $600, has acted as a work disincentive? We keep reading again and again that because indeed many people are making more with the benefit than they did before, that they don't want to go back to work.
Yeah, so there is not evidence of that as of yet. I'm actually looking in my my written testimony. I have this fantastic chart, which I'm going to hold up on the screen because I can do this in this video land here. But there's a chart. It's not in color because I don't have a color printer at home. That shows that 70% of unemployment insurance recipients who returned to work in June actually earned more on UI than they did in their prior job. So this is from late-breaking data from a number of scholars, a number of economists, and there's a bunch of other evidence. There's a number of studies also cited in Jared's research that indicates that really what is hampering people from getting back to work is the uncertainty around the coronavirus, the uncertainty about whether or not the job is available and open. I mean, remember that the bulk of the job losses have been in those face-to-face industries. So if you are trained as a chef or you're trained as a waiter and your restaurant just isn't opened yet, it's very difficult to go back to work still. So we have to sort of bear that in mind. But what we do know from the emerging evidence is that as jobs come back online, people are jumping back into work. And I think in no small part because most people understand that work is the path to maintaining their income. And that's also the way that most people get their health insurance. So we've created really strong incentives for people to focus on getting back to work. And the evidence so far is not that the $600 is the key thing that is preventing people. And I just want to stress that it really is the key thing that's keeping spending going. And if you want to be creating more jobs, you have to sustain that consumer demand. We have to keep people paying their rent. We have to keep them spending in their communities until we contain the virus.
Thank you very much. Dr. Bernstein, one of the current Senate Republican plans is to cut the $600 to $200 for an interim period, then move it back up to a replacement of 70% of the workers' past wages. Georgia's labor commissioner, Mark Butler, who's a Republican, called the 7% wage replacement model, which would put strains on already overwhelmed state unemployment offices, the quote, the dumbest idea ever. Do you agree? What do you think of this 70% replacement model?
Well, the dumbest idea ever is a really high bar. I think probably more to the point is it is unimplementable within 2 months. I say that with great confidence because I've spent some time, in part as my role as chair of the board of the National Employment Law Project, with extremely close granular information on this, that because we have 50 different state unemployment insurance systems, and some of them are demonstrably quite creaky, which is why we had to do the 600 plus up in the first place. They simply don't have the administrative capacity to achieve this, which means that the 200 would likely get locked in. So what we should be worrying about is the impact on the macro and micro economy from this cut. I agree with a lot of what Doug said about the importance of this spending to supporting the economy through this very difficult period. What would have been a deep recession would have been a deep depression without it. If we were to go to 400, from 600 to 200, Mark Zandi, I have in my testimony, the economist estimates that this would be a loss of 1 million jobs, and it would raise the unemployment rate by more than 0.5%. Now, the unemployment rate is already 11%, which is higher than its peak in what we used to call the Great Recession. That would mean an unemployment rate of probably north of 11.5%. So this is terrible micro, leading to, in my view, cascading hunger and evictions, and it's terrible macro, pushing exactly the wrong way on an economy, which is very clearly in a stall right now.
Dr. Bernstein, thank you very much. Let me now recognize our chairman, Senator Lee, for your questions.
Thank you very much, Mr. Chairman. Ms. Gressler, you've highlighted a number of reforms that could improve employment opportunities and flexibility for workers beyond the pandemic once this thing is over. This includes allowing workers to choose between paid time off and overtime pay, as the Working Families Flexibility Act would accomplish. How would those kinds of policies improve economic resilience as compared to an extension or an expansion of automatic stabilizers?
So families need to feel like they are in control and to be able to act quickly based on what's best for them. Under the Working Families Flexibility Act, a lower wage worker could have accumulated a week, 6 weeks, however much amount of paid time off that they can cash in whenever they want. The problem is when you have a government program that is in charge of those things, Washington State has a new paid family leave program, and yet people were told they can't apply to the program. They're overwhelmed. They were waiting a month before they could even apply, and then months more before they could get benefits. And so you end up seeing how you don't actually have control when it's a government program. And I agree with everything happening on the UI front, but the problem there is that the programs can't handle what we wanted to do, which was to replace 100% of people's incomes. And so it was that failure of a government program to do the right policy that we instead ended up with this flat benefit of $600 that might be $200. So we need to have more flexibility, having options like independent work where you can just pick up a job and go out and do it, instead of having governments like California that are trying to outlaw those types of work.
Okay, thank you. That's helpful. This next question will go to you, Ms. Gressler, and also to Dr. Holzaken after you answer. There's bipartisan agreement around the need to reform the budget process and the budget itself in order to address what has become a really unsustainable debt trajectory. And we certainly need to do that once the economy is on more solid ground. And this agreement was recently underscored by a letter calling for budget reform that was signed by 60 members of the House of Representatives. I sincerely hope there is political will for that, as we failed to implement important budget reforms after recovering from the Great Recession. So again, Ms. Gressler, first to you, and then to Dr. Holzaken. In your opinion, would expanding automatic stabilizers worsen our current national debt trajectory?
Yes, and that's the problem, is facing the situation where we're basically putting everything on the credit card. We wouldn't tell households every time you hit a bump in the road, your car breaks down, you lose your job, put it on the credit card and don't ever pay it off again in the future. And that's effectively what we're talking about here. And so there needs to be changes to those processes, particularly addressing the mandatory spending side.
Dr. Holsaken, do you agree?
Yeah, as I mentioned in my opening remarks, the mandatory spending is a key part of our long-term budget difficulties. The reality is that prior to the pandemic, the federal budget was on an unsustainable trajectory. We're going to emerge at some point back at full employment on an unsustainable trajectory, jumping off a much higher level of national debt. And all I'm asking is that the Congress at some point stabilize debt relative to GDP. That's the minimum that a nation should be capable of doing. We've not done that in the 21st century, largely because of our existing mandatory spending programs. Adding new ones is unwise at this point, in my view.
And so expanding automatic stabilizers would increase the federal budget's mandatory spending. And so that in turn would leave less room for discretionary spending. It seems to circumvent the legislative process. And it's something that seems to mean that legislators are better equipped to be able to escape their responsibilities as elected officials. So, Dr. Holsaken, does expanding automatic stabilizers make members of Congress less accountable to their constituents, and are policymakers better able to respond to a crisis using real-time information rather than just putting everything on autopilot?
It is a clear attempt to tie the hands of a future Congress, circumvent their sole responsibility to respond to events. And it cements an existing budget problem that has nothing to do with the gap between the revenues and the spending. The fact is that we spend too little on basic research, infrastructure, education, national security. Those are discretionary categories because they're getting crowded out of the budget by large mandatory spending programs. So if we're going to get back to investing in the future security and growth of our country, we're going to have to free up discretionary choices of Congress. This goes the wrong direction.
Well said. What makes life easier for members of Congress doesn't necessarily make for better policy or better accountability for the American people. Thank you, Mr. Chairman.
And I recognize Congressman Denny Heck from the state of Washington. And Denny, you are still muted.
Are you sure? Can you hear me? Give me my 12
we can hear you
seconds
now,
now.
yes.
Before I ask my question of Dr. Bernstein, I have to respond quickly to 3 forehead-slapping assertions that have been made here. I find stunning. The idea that we could recalibrate unemployment compensation to a percentage of income. My State Department of Employment Security tells me that it'd take a minimum of 10 to 12 weeks, during which time enormous amounts of human suffering will occur. Secondly, perhaps most stunningly, the idea that Social Security is a, quote, sham. Social Security is inarguably the single most effective poverty reduction program for the elderly in the history of the world. It is not a sham. And thirdly, this idea about automatic stabilizers taking decision-making away from the Congress, who is better equipped to do it on their own. Oh yeah, we have a net negative approval rating of 58% right now. And no small part of that is because we're failing to step up and act and respond to the pain and misery out there. I have 2 images I can't get out of my head. One is a Herbert Hoover imitation going on right now after the onset of the Great Depression, a suggestion that the free market's just going to take care of this. Wake up! The free market isn't taking care of this. And the second image is of Thelma and Louise in the final scene, where Louise slams the pedal to the metal and they grasp hands and they go out over the cliff as we shoot past the unemployment enhancement benefit, as we shoot past eviction protection. I'm not holding hands with anybody and going over this cliff while Americans suffer. Dr. Bernstein, I am shocked and disappointed, Jared. You didn't mention rental relief. Last month, for which we have data, 30% of Americans couldn't pay all their rent. 20% couldn't pay any. Day after tomorrow, the rent is due. We have people exposed beyond belief. The next step for those states where eviction protection isn't put in place is they're going to be evicted. They're going to be more homeless. They're going to be sleeping under bridges and any other issue in their life isn't going to be taken care of, whether it's mental health or unemployment or substance abuse, or they're going to move in with other people. Read here, create a petri dish for the expansion of COVID-19. 160 co-sponsors of the House passed version, 950 national and local organizations supporting rent relief. Jared, tell me, please, as you have written and said before, this is a critical part of what we must do to respond to this problem going forward.
I certainly agree with you. That very much emphasized in my written testimony. In my spoken testimony, I mentioned the threat of cascading evictions, and I couldn't concur more with everything you just said. By the way, including this debate about discretion and mandatory, I'd love to get back to that because I really want to argue with my colleagues on the other side about that. I think they're conflating entitlements with countercyclical policies in a way that's really just, bad economics. Look, here's the thing that I want to underscore. I know you know this, Representative Heck, but this is something people don't appreciate enough. Even when you have an eviction moratorium, it doesn't mean that you don't have to pay rent. It means that your rental payments often accumulate to the other side of the moratorium. So when the moratorium ends, there you are stuck with a bill that you can't possibly make if you're a low-wage, low-income person who's facing joblessness in this labor market. In this regard, enhanced unemployment benefits have been a lifeline, and as they fade, it's going to cascade down the chain to landlords, to banks, to investors. This is a problem on every level of our economy. What I appreciate most about the plan that you're talking about is it is fiscal relief. It doesn't just tell people, here's a few months where you don't have to pay your rent that's going to come crashing in on you after those months are over. It actually relieves you of those rental payments. And I know you have significant resources devoted to this in the HEROES Act. And I deeply, deeply urge the Senate, if they want to avoid a cascading homelessness problem, to put that in the next relief bill.
Thank you, Jared. And a reminder to everybody that more than 50% of rental units are owned by moms and pops. These aren't national corporations. These are people who chose to build for their retirement security, not through the accumulation of a 401k, but by buying one or two or three rental homes or duplexes. This is a whole housing ecosystem that we must rescue for this period of time if we're to avert disaster. Thank you, Mr. Chairman.
Thank you, Congressman Heck. By the way, recent numbers from Fannie Mae and Freddie Mac suggest that 80% of the multifamily mortgages that are in forbearance are those moms and pops. Those 50% that are the C class. Let me now recognize the Congressman from Arizona, David Schweikert, for his questions.
Thank you, Mr. Vice Chairman. Instead of spouting off on some of the things where I wish, I think we were having a little bit of partisan interplay on some of our facts. I wanted to actually try to see, is there an overarching, a holistic vision? So, Mr. Holtz-Eakin, if I turned to you and right now and said, instead of speechifying, I turned to you and said, give me a playbook that you would see for the next 6 months that brings us as much stability and opportunity for the populations that have been just crushed. What would that 6 months plan look like?
So my thinking on this is heavily influenced by the experience of the U.S. after the terrorist attacks of 2001, where it became clear we had a threat to the U.S. population, and the top priority was to deal with the threat. But it was also necessary to operate the economy in the presence of that threat. And we spent a lot of national effort and time doing that. It involved enormous amounts of regulation in the interest of national security, not all of which I think was a good economic idea. We set up the TSA so people would feel safe on planes. We inspected every cargo container that came to the US at enormous expense. And in general, we raised the cost of doing business enormously. And the economy didn't perform very well. And there was fiscal stimulus in 2002 and 2003 and 2005, and then again in 2008, and none of it was terribly successful because we weren't taking care of the supply side conditions. We're in the same position now. We do need to get workers back into workplaces safely. That's going to require some modifications of workplaces, some PPE in the near term, a much better testing strategy than we have at the moment. Those are all costly endeavors. I think helping out that adjustment is important. We're going to need to provide owners with some security that they're not at risk of lawsuits. If they take reasonable precautions, they should have some liability protection. And we're going to have to make sure that we do not overuse the federal bonus to do two things. A, provide income to individuals, but B, provide a barrier to reemployment. That's the problem. The higher is the income supplement, the bigger is the barrier to reemployment. So it's too high. It needs to be lower. I'll leave it to the Congress to decide where the appropriate compromise is, and then look at the rest of the package to make sure that you have adequate income support so that you don't actually have a demand failure in the second half of this year. But if you do all of the demand things with nothing on the supply side, I really fear we will be very frustrated and unsuccessful in getting people back to work. And in the end, it is going to be a long, hard thing to get people back to work. And past the next 6 months, we will have to worry about genuine movements of people from one sector to another as the economy reconfigures, as it always does in the aftermath of a recession, but will even more so in this instance. So for 6 months, I think you've got to have some supply side elements. Make sure you don't absolutely cut off all the demand, but that's not where the key problem is.
Okay, so you actually brought up two things that have been bothering me and I've been trying to figure out. So you do what's necessary in many ways to keep demand stable, or at least to act. How do you then also build the incentive that, and here's your demand stimulus, but we also want to provide the incentive for every individual to be able to go back to work in a safe manner? Do you provide a stimulus or bonus or demand side spiff to actually go back to work?
You could put in a reemployment bonus. I think it would be enough to lower the barrier by, taking the 600, where 2/3 of people have a replacement rate over 100%, and then get it down to something more close to traditional levels. There's a lot of evidence that high replacement rates extend periods of unemployment, extended benefits extend spells of unemployment. We just need not to overdo that and damage our capacity to respond. So do that and do that well. We really do need to fix the testing. I could go on for longer than I want to right now, but the bottom line is these clinical level tests, the PCR tests that are so expensive and take so long, are not necessary to identify infectious individuals. A $1 test, and there are 3 of them that are approved by the FDA, can identify an infectious individual. Everyone should get up every day, take a test, and if you flunk, don't go to work, don't go to school. That's what we need, and we can do that right now. Instead, we're putting clinical tests at the heart of this. That's a mistake.
We're actually, we just introduced a piece of legislation to actually provide a credit on your payroll side to be able, so you get the credit almost immediately. We don't have time for it right now, but we've also been working on the impact of not having, a robust daycare, not having schools, those other things, and the long-term impact that would mean, particularly to female workers, that we're finally seeing, that remarkable movement in income, and it's now been crushed. I have an intense concern. I think there's Republican and Democrats. We need to get this policy going again. So the separation of income differential that's happened these last 6 months, we all need to start working on finding a way to have a path to close this again. And with that, Mr. Vice Chairman, I yield back.
Thank you, Congressman Schweikert. We'll have now recognized Congressman David Trone from Maryland for his questions.
Mute off. There we go. Thank you, Mr. Chairman. Dr. Bernstein, the National Bureau of Economic Research tells us that 41% of Black-owned businesses, 32% Latino-owned businesses, 36 overall immigrant-owned businesses have permanently closed. Last week, I helped introduce a Jobs and Neighborhood Investment Act with my colleague Greg Meeks of New York. This legislation would make about $18 billion available investment for low-income and minority communities that have been hit hard by COVID. It'll give these community development financial institutions and minority deposit institutions capital, the liquidity, and the operational capacity to expand the flow of credits into the underserved communities. What benefits do you expect to see from expanding the credit access to these minority-owned businesses? And also, what else should we be doing to shore up these impacted businesses?
Excellent idea, but an idea that should have bipartisan support. It is widely understood that credit markets fail in massive terms when it comes to providing access to capital for the very folks you're targeting with your bill. We know this from PPP statistics that if you essentially couldn't call up your banker and get at the front of a line for a loan, oftentimes you went without it. And if you look at the results for the PPP, you see precisely that kind of disproportionate racial injustice that you describe. So that's a critically important piece of this puzzle. I think the point that I would make is that we've seen throughout this crisis that when we provide businesses with low-cost credit, some of them will take it and some of them won't. And one of the reasons we know that those who don't take it is because of the uncertainty. That, in fact, is the theme of this hearing today. They just don't know when revenue is going to start flowing again. So in this regard, to the extent that grants can take the place of loans, I think they could be even more helpful for some of the kinds of businesses we're talking about.
I think that makes a lot of sense. The aversion to taking on debt is something these small businesses are really going to feel be part of their business. Okay, Dr. Boucher, this week the Center for Economic Growth put out a report describing home ownership rates declined the most since the Great Depression, and how these declines are concentrated on the bottom half of the income distribution among Black and Hispanic families. So housing is clearly the most important source of wealth for most US families, and thus it's a wealth equalizer. And as we debate near-term approaches to stabilizing the economy and American families, what actions do you recommend we take to reverse this trend to help all families be able to buy their home?
Well, I think it's a great question, and it's so important right now as so many families are struggling to be able to afford rent and to be able to continue to pay their mortgage. I think that the key thing right now for so many families is being able to have that income. And so a lot of it does come back down to continuing to extend those additional unemployment benefits. So those families that are out of work and don't have that income to continue to pay their mortgages. I know in my family, we have folks that are unemployed, and that is the most important thing, is those benefits are making the difference between being able to pay that mortgage and not. I think as we look a little bit over the longer time horizon, one of the things that came out in this study is how homeownership is declining for younger cohorts of families. And those are families who haven't saved enough. These are people that graduated into the Great Recession that we know have seen lower lifetime, lower income because of what happened over the past decade. So a lot of it, I think, really focusing on ensuring that we are doing everything we can to stabilize that labor market, especially for young people, is one of the best investments we can make to allow them to build up that capital and to buy homes in the future.
Yeah, that makes sense. Dr. Boucher, you've written about the negative impact on income inequality among the average American worker, and how that inequality harms our country's long-term economic prospects. And you've advocated for investments in early childhood education programs, quality government-funded child care, crucial to building ladders of opportunity for economic growth and stability. These sound like policies we should be thinking about today to stabilize the economy, get people back to work, but expensive. How would you reconcile the costs against the outcomes, and which we won't know for sure for many years?
Well, one of the things that,
Dr. Boucher, if I can interrupt.
Yeah.
If you can hold your answer to that for the second round,
okay,
which hopefully we'll get to in about 10 minutes.
will do.
All right. Thank you very much. And thank you, Congressman Pertrone. Now
Thank you.
recognize Congresswoman Herrera Butler from the state of Washington.
Hi there. I don't know if this part has been talked about yet, but I serve on appropriations here in the House, and obviously 70% of government spending is mandatory, and interest payments leaving Congress responsible for about 30%. I think it's concerning that expanding economic stabilizers to create more mandatory spending, I think, is going to worsen the issue. What changes do you, and this is open to the panel, do you think can be made to existing stabilizers to make sure that they're more effective rather than creating new ones? I think, yeah, I'll end it there.
I can jump in, is that you don't have to have the programs automatically turn on. I would like them to do so, but we can have an honest difference there. What you don't want them to do is to turn off too soon. And I gotta say, I mean, I hope you would agree that Exhibit A for this problem is that as we speak, enhanced unemployment benefits are expiring tomorrow. And I think, at least on a bipartisan basis, as far as I can tell, that's something that nobody wants to happen. I mean, Doug was very clear about this a few minutes ago, and I appreciate his candor. So one potential solution is to make sure that the triggers that we're talking about disallow programs from shutting off too soon.
And I would just add here that when we talk about expanding more programs or adding additional components to existing automatic stabilizers, there's a big difference between treating that like saving ahead and putting it on the credit card. And so anything that we're talking about doing in the future, if that's a decision that's made, that needs to be funded in advance. But I also would encourage policymakers to look more to state and local levels, especially during this pandemic. There's a lot of uncertainty, and a lot of that is not, equal across the US. Is schools are making decisions. Parents don't know if they're going to be able to work or not in the fall. And that's going to affect unemployment rates. You're going to have more people out of work. And so that's more a local decision. I know that in my particular county, we have special grants to small businesses, especially including childcare. New York City has made the decision that they're going to subsidize childcare. These are things that need to be tailored to those state and local governments in a better way.
I'm happy to weigh in on this as well. On the, when you think about the unemployment insurance system, it does have longstanding local triggers that are supposed to trigger on these extended benefits in times of very high unemployment. And what we know about them is that they typically haven't worked as well as we would like them to. They don't trigger on fast enough. And so there has been a lot of work, especially over the past decade, given what we learned during the Great Recession, to study how we can make these triggers more effective. I think Jared's point that we don't want these benefits to trigger off too quickly, but we also want to make sure that when the unemployment rate spikes because of a shock to our system, like we saw during COVID, that you immediately you make sure that those benefits go out to people. We've advocated for a long time at Equitable Growth that these are things that we should be focusing on in good times so that the system was ready for the next recession. Given that we're here, we should be making sure that any steps that we take also shore up unemployment insurance for the long haul, so that we are acknowledging that people need these benefits, and we do need to acknowledge that we need to shore up the system so that we upgrade the computer systems and all that for next time, because it will happen again. One thing I want to remind us, though, is that when we put in place the unemployment insurance system as a part of the Social Security Act in the 1930s, the wage base for Social Security and the unemployment insurance systems were about the same. And over time, the wage base for Social Security has grown with inflation. It's now over $120,000 a year or somewhat. But that wasn't what happened with the unemployment insurance system. So we've allowed the tax base for that to atrophy, and that's also a place that we can focus on. If we would have allowed that to increase, then we would have more revenues going into the system, and we wouldn't be here talking about deficits right now, because it does have a functional pay-as-you-go system, just like that was built into the system.
So these are fine discussions in the abstract. They always sound wonderful. As a practical reality, what it would do right now is lock in a $600 benefit that everyone agrees is too large and that has to be dealt with in some way. And if we'd gone doing this on an automatic fashion coming out of the Great Recession, we would have arrived at the beginning of 2012 with the unemployment rate still at 8.3% after reaching a high of 10, at which point we began to phase out extended benefits through 2012 and 13. And when it was finally done in 2014, by the end of the year, the unemployment rate was down to 5.6%. So to do what they're suggesting is to lock in high unemployment for a sustained period. That's a bad idea.
With that, thank you, Congresswoman Herrera Butler. And we'll now hear from the senator from the Granite State, Senator Hassan.
Oh, thank you, Vice Chair Byer and Chairman Lee, for holding the hearing today, and thank you to all of our witnesses for participating. I have a question first for Dr. Bernstein and Dr. Boucher. The majority of Americans live in states that have paused or reversed their reopening plans because of spikes in COVID-19. It's clear that we cannot recover economically unless we first contain the COVID-19 virus. So could you each comment on two things? One, on the importance of virus containment for successfully reopening the economy, and contrast our economic outlook in the United States compared to other countries that have taken a different approach to virus containment. And why don't we start with you, Dr. Bernstein?
Thank you. Let me start with your second question because I think it's such a dramatic difference. It's actually figure one in my written testimony, if anyone has that handy by. I just posted something like 6 graphs of cases in the United States compared to Germany, South Korea, France, Italy, where, of course, they had an awful problem with the virus initially. And they did 2 things much better than we did. They controlled the virus through testing, tracing, and quarantining. And they also helped people stay connected to work more. They focused more on making sure that when the economy could ramp up, people would be connected to their workplace. And that has been shown to give it a recovery just more kind of economic liftoff because it's much easier to kind of dial things up when the workforce is still in place. So that was tremendously important. On your first question, it's just that everybody's quoting these days the chair of the Federal Reserve on this because he's a very important guy in this area, but also because he said it so plainly. Essentially, I'm paraphrasing, there's just not going to be an economic recovery without virus control. Right. It's that simple.
And Dr. Boucher.
100%.
Be relatively quick, just because I want to get on to another topic.
Exactly. 100%. I agree with Dr. Bernstein that, one of the best things that we can do is ensure that we have this short-time compensation, that we allow people to extend their UI and be able to maintain their connection to their employer. We've seen that work in other places. That is one of the most important things we can do. And there is legislation on the Hill to do that. But I think that the other thing is it's testing, it's contact tracing, and it's protective gear. And I think two of the most important things that we could be doing is the administration needs OSHA to give very clear guidelines with accountability to make us feel safe as workers and consumers. And we need to make sure that that firms are being held accountable to that. So we don't need to do the getting rid of liability protection for them. So I think those are also things that are going to help us make sure that we open up safely and reduce uncertainty.
Thank you very much. Dr. Bernstein, I want to turn to another critical issue. The CARES Act provided vital emergency assistance to state and local governments that my state of New Hampshire has used to support small businesses, nonprofits, hospitals, and childcare. However, as pointed out by your colleagues at the Center on Budget and Policy Priorities, state budget shortfalls due to COVID-19 could ultimately be the largest on record. Can you comment, please, on the economic importance of additional aid to state and local governments during the crisis? And how would it harm the economic recovery if Congress failed to provide additional assistance?
Really important question. Without additional assistance, the recovery is going to be much slower and take much longer to gain traction. We know that even in May and June, when the labor market was adding millions of jobs, that state and local governments were hemorrhaging employment. I suspect they were the only major sector to do so. They shed 1.5 million jobs over that period. Just a terrible outcome. And it is inevitable that we are going to see more of the same without more fiscal relief. In the last recession, when I was working for the Obama administration, state and local fiscal relief was one of our most important programs, particularly through enhanced FMAP matches, which is the most efficient and effective way to do this, in my view. And it has an extremely high economic multiplier. That money gets spent and it reverberates through the whole economy.
Well, thank you very much. And thank you, Congressman Boucher, for holding this hearing. And thank you to all our witnesses. I yield back.
And I apologize for not pronouncing Hessen right.
It's all right. It happens all the time. Thank you.
That's great. We would love to do a second round for anyone who is willing to stay. And let me kick it off by first pointing out to my friend, Congressman Herrera Butler, that the best way to deal with mandatory spending in the long run is to fix Medicare and fix Medicaid, with evolving healthcare, and to make sure that we fix Social Security. John Larson, Social Security 2100, pays it all ahead so that we don't have to think about it as mandatory spending, because drawing down money has been set aside, as the Social Security insurance says it is. I also want to reiterate, I think it was Dr. Boucher's point about the base. The base in Virginia is $8,000 for unemployment insurance. I pay it for our occasional housekeeper. It's 0.1% on that $8,000. So for I think $8 a year, I can afford her. Not much of a contribution to the state unemployment insurance fund. Dr. Boucher, I had the opportunity to be on the BEA call this morning at 8:35 on the GDP, fascinating, the 32.9%. And taking it apart, of that 33% rounded, 25% was decreases in consumption. 4% was decreases in inventories, mostly car dealer inventories. So it was overwhelmingly decreases in personal consumption, but it wasn't goods. People bought just as much food as they did before, just as much gas. They spent just as much on housing and utilities. Where the decline was in healthcare, in recreation services, in food services, and in accommodations. Basically all discretionary income things. So when we think about that $600, that unemployment insurance, I'm leading to how they flow through to economic growth and job creation. Doesn't it fall right out from the numbers that all of that $600 was spent on things that those people needed to survive?
That is certainly what the evidence points to. Let me talk about some research. Economists have been able to analyze all of this just-in-time data that's been coming out. And one of the most interesting studies has shown that actually especially sort of middle and lower income communities, because of the additional money flowing to them from Congress, you have actually seen spending stabilize. And that has actually been able to support those local small businesses in those communities, because most of what they're buying are things that they need. What we're seeing in higher income communities is that because there's more discretionary spending, and because people aren't going out to eat, they're not buying fancy new shoes and the like, many of those small businesses are struggling because that discretionary spending is falling down. So I wanted to start with that example to make that connection between the $600 that's going out to families and what it's doing to local economies. And that those families that need it, who are living, the majority of Americans who are living hand to mouth, who don't have a ton of money in the bank, or being laid off or having their hours cut, means that they don't have a lot to rely on. They're spending that on things they need. And so we need to make sure that that money gets out to them. And on the other hand, in those higher income communities where they have more discretionary spending, they're also cutting back, and that's harming those businesses. So with all of it, the today's GDP numbers really do just underscore the importance of what you all did in the CARES Act just a few months ago.
Yeah, thank you very much. By the way, that same notion of the people at the bottom need every penny to spend just to survive. The annualized savings rate in the second quarter was 22%, the highest in the history of the Republic. And that was not those people that were getting unemployment benefits. Dr. Bernstein, all through the post-Great Recession, we kept hearing that certainty was phenomenally important for businesses to make investments, to open new stores, to hire people. How much role does uncertainty play in the lives of the people that lost their jobs in the last 3 months? Not knowing whether the unemployment benefit was going to be extended for the 30 million people without a job.
I think that the problem of uncertainty, which by the way has been of great interest to economists going back to Keynes. If you actually read Keynes's analysis of fundamental problems in the economy, uncertainty is at its core. And he's very clear to connect this to when markets fail, and that there is a role for government to dampen this uncertainty. If you listen to the Federal Reserve today, they'll tell you the same thing. And they very much emphasize this notion of forward guidance, that is telegraphing to markets what they're going to do to tap the economic benefits of reduced uncertainty. So people, and I go through this in my written testimony, people will simply not plan to take a vacation, so they won't book a home. They won't plan to invest in their house, so they won't hire a construction firm, and it just ripples through. The members of that firm have less income, and then they do less spending. So this is a really problematic economic infection right now. And I've argued that this is something Congress can actually really do something about by getting together, as Congress did in the initial parts of the pandemic, and act with the kind of urgency that they acted on back then. The virus is wearing just as badly as it did then, but congressional urgency has diminished in an extremely troubling way.
Great. Thank you, Dr. Bernstein, very much. Now recognize Chairman Lee for a second round of questions.
Thanks so much, Mr. Chairman. Okay, let's pick back up with Ms. Gressler and Dr. Holzeken, following up on some of the things we covered in the last round. The CARES Act relaxed a number of restrictions that are associated with savings accounts like IRAs and health savings accounts, so that Americans could more easily reach into and tap the resources that they have. A recent Social Capital Project report that we produced through the Joint Economic Committee staff suggests that policymakers could ensure that Americans have access to future savings by creating universal savings accounts. These accounts have significantly increased savings among account holders in both the United Kingdom and in Canada. So I'd like to know, what do you think of universal savings accounts as an option to help improve Americans' future financial stability, and what other policies could help Americans become more prepared for future crises?
Well, Chairman Lee, I do want to say at the outset that we've kept track of the COVID-related relaxations of regulations in the aggregate at the American Action Forum, and there are well over 800 instances of using emergency authorities to waive regulations. That's prima facie evidence that we have too little flexibility in the system, and that we ought to think very hard about making many of these waivers permanent, as you suggested at the outset. Telehealth is the leading example. Telehealth has been an enormous boon in the midst of these physical restrictions, and it's due to the waiver of restrictions out of HHS that you can now do this. So I think that should be on everyone's radar screen. And I want to embrace the idea to have the option for a universal saving account. We know that too few Americans have access to the traditional three-legged stool with a private pension, personal savings, and Social Security, and are largely focusing on having only Social Security. We need to rehabilitate the private sector's contribution to retirement saving and having the flexibility during their life cycle to meet emergencies. So that'd be a good way to do that.
Ms. Gressler, how about you?
Yeah, and I'll just add on the savings side there, the reason that a lot of lower income people don't have savings accounts, at least in part, is because it's often difficult to save. You don't know which account you're going to save in and what limits are going to be put on it, or are you going to be charged a fee if you take money out early. But if you have one simple account that everybody can use for whatever purpose they want and whatever time they want, then we know that people are going to save more. In Canada and the UK, as you noted, 50% of the accounts that were opened under universal savings accounts were low and moderate income savers, and they actually put a higher percentage of their income into those accounts than did the higher income group. And so we know that this is an opportunity out there. And in this current pandemic, you know, if the UI benefit didn't come in time, they would have had that account to at least hold them over.
Ms. Gressler, when we look at automatic stabilizers, one of the things that I think can be helpful is to look at existing automatic stabilizers and see what impacts they've had on the economy. And the current pandemic reminds us of the fact that the economic stabilizers can have a significant effect on the economy, not always for the better. For example, since March 21st of this year, nearly 50 million Americans have applied for unemployment insurance. This is a rate 14 times higher than that found during the same period of time just last year. And at the same time, due to delays in the overall ineffectiveness of the unemployment insurance program, many Americans were left waiting for the relief that they needed and still need. So in light of that, should policymakers consider improving the automatic stabilizers we already have, for instance, by addressing the delays plaguing unemployment insurance system to make them better? And if so, what are some ways that policymakers can do that?
Well, I think we should expect the same from government that government expects from private individuals and businesses. And whereas they can change tax laws and payroll provisions and other things on a dime and expect the businesses to be able to adjust, we should expect that government should be able to adjust these programs. And the fact is that they are not able to. They are so antiquated that they can't adjust to provide a match at 100% of somebody's income when their benefit is already based on income. It's a little bit incomprehensible that they can't do this. And so it just draws to the fact that you can establish all these automatic stabilizers and new government programs, but the reality is they might not be there for you when you need them. But I would say, you know, whenever there is a stabilizer, fund it ahead of time and make sure that you're stress testing these things. Will they be able to benefit people when needed?
Thank you. Thanks, Mr. Chairman.
Yeah, thank you, Chairman Lee. And I recognize the Congressman from Washington, the champion of the rent payer in America, Congressman Heck.
Thank you, Mr. Vice Chairman. I actually want to stay on the subject of housing. Seems to me that we've got a confluence of factors and known facts here that might suggest a path forward that we ought to take. For example, we know we have a serious housing shortage in this country. We know that we have an even greater shortage of affordable housing. We know that as occupancies go up, rents go up, and people become more rent burdened, and there are a higher number that are rent burdened today than ever before. But we also know that construction of housing units has, until the last recession, helped lead us out of every recession in modern history. And it seems to me this suggests that we ought to be pursuing this. I obviously have my own idea, the Fulfilling the Housing Trust Fund, which would convert the 10 basis point G fee adopted by Congress 10 years ago to pay for the payroll tax during the last Great Recession to the purpose of building affordable housing as a means of helping people with housing, as a means of helping accelerate economic growth and all the job creation associated therewith. So for Jared and Heather, I'd ask your reaction to that particular idea briefly, but more importantly, what other kinds of things, given the fact pattern, should we be pursuing? And this time, let's start with Heather, if for no other good reason than she is a proud native of my home state.
That I am, proud Washingtonian. Happy to see two Washingtonians on this call today. So I am not familiar with your legislation, so I don't feel confident in I don't want to comment on that specifically. I mean, I think what I can say though is that this idea that in previous recessions, housing has what has been pulled us out, is a really important point to be thinking about in the current crisis and how we're going to build towards recovery. So I think for the most part, today's conversation has been about relief. We're in this crisis right now, and we're thinking about how we get immediate relief. You're asking us to think about, well, what's the next step? How are we going to pull? We're going to have this long-term lag from the crisis. How are we going to pull ourselves out? And I would say two things. One is that unlike some prior recessions, because of the nature of this, because of the sharp drop in, because of COVID requiring everyone to go home and the sharp drop in employment, it was different than, say, the Great Recession or other prior recessions that did cause this, that were caused by different kinds of shocks or caused by what was happening in the last recession in the housing market itself. So the first thing is you don't have that overhang of housing like you had last time. So that does, I think, bode well for the idea that we should be thinking about this as a place for investment. I think we should, and I don't want to take the focus off of housing because I know that you're elevating that as really important for family economic security. I think we also need to be thinking more broadly about the other kinds of public investments that we need to be making in communities. So when you say housing, I'm also thinking about how we can make sure that we are thinking about the energy needs, that we're thinking about the kinds of green investments that we need to make, and that this housing plan is consistent with addressing climate change over the long term. I'm thinking about the transportation networks that you need to have and making sure that those are environmentally sustainable, that are consistent with the housing plan that you're talking about. And I'm thinking about access to good schools and care. We know that there is this massive crisis in access to childcare, and how are we connecting those dots to where people live? Because the commutes to both jobs and care has become such a critical issue. So I think I would like us to put the housing issue within the context of a broader investment strategy that the United States should be thinking about in the coming months and years, as soon as we get out of this immediate crisis of making sure that people have their unemployment benefits.
Jared?
I've endorsed the idea of seeding the Housing Trust Fund with precisely the funding mechanism you've talked about, and if Congress does it in a timely manner, which would be soon, it would be seamless. That is, a stream of resources would go from one program where it's not needed to another program where it's needed. So that is an efficient and important idea. The only other thing I'll say, I suspect we're hitting a time constraint here, is that the other thing I would do in this space is make sure that the housing voucher program is fully funded. The share of eligible people for rental vouchers who gets them is tiny. I don't have it off the top of my head, but it's something like 1 in 6 or something. It's really a terribly underserved program. So we could house a lot more people a lot more securely by fully funding our housing choice voucher program.
Thank you, Mr. Chairman.
Yes, thank you, Congressman Heck. And I recognize Congressman Schweikert.
Thank you, Mr. Vice Chair. Look, I love the conversation about should we be building plans to do counter-cyclical, automatic mechanisms. But in some ways, we're actually living some of that right now with what we have already done policy-wise. And to Ms. Gessler or Holtz-Eakin, I'm seeing stories that there's $2 trillion that have actually moved to bank accounts. They didn't actually move to velocity in the economy. Is that an argument that the way we're delivering this, it's not actually creating the stabilization or stimulus in our society that we wanted, but in many ways is shoring up savings, bank balance sheets? And what would the economy look like right now if that $2 trillion or even a substantial fraction of it was actually circulating instead of shoring up bank accounts? Am I seeing something that is worth understanding, that this became the natural reaction of some of the stimulus we pumped into society, or the federal government, or excuse me, the Federal Reserve pumped in?
Rachel, go ahead.
Yeah, well, I'd say this highlights the unique nature of the crisis that we're facing now. And so certain sectors of the economy have been hurt far more than others. There are a few sectors that are actually booming, and we don't know exactly what all this additional savings, who is it going to for sure. Savings rate was 32% in April, 23% in May. So we do know that a lot of households have savings sitting there that they're not spending. And if we send additional money out, just blanket checks to everybody, it may not be very effective. And so I think this argues for really targeted assistance to the people who don't have job opportunities right now, to be focusing on those and not just sending out, widespread more money, pumping it out there. If it's not actually going to do any good, it's actually going to tip us towards instability in terms of our debt in the future.
And Rachel, sort of derivative of the point you're making, I think I actually even saw something that credit card balances and those were also being paid down too. So it was more than just savings rates going up, some of the debt carried forward. It's a really interesting, both for the Keynesian in us and the supply-siders in us. Some of it's not working the way we would have conceptualized.
Exactly. You can't force people to go to restaurants and hotels and travel when they don't feel safe doing so.
Doug, should I see this as a fragility on some of the discussion we're having today of we should have all build these types of automatic shock absorbers? And for what we're seeing right now, it basically shored up people's bank accounts and debt loads. And is there something we should do right now, policy-wise, to get that money or to incentivize that money to circulate in our society?
I think it's a reminder of the fact that there are severe supply constraints on the economy, and that they've returned recently with rises in outbreaks in the South and West. And in those circumstances, you can give people checks, but if they don't have any place to spend them, they're going to end up in the bank. We transferred at an annual rate $3 trillion in April to the household sector, another $2 trillion in May. That's an enormous amount of cash flow, and $2 trillion of it ends up in bank accounts that wasn't in there in February. Unless we deal with the supply shortages, demand approaches alone will not solve this problem. That's one of the major lessons I think we've learned so far.
Okay, so we're sort of in the classic, almost a classic demand versus supply squeeze.
So I think I want to be careful about this, because I'm not advocating for throwing away any interest in maintaining the level of income and demand support going forward. That would be a really big mistake, but I don't think it alone will be sufficient. We need to deal with the supply problem. Here's the issue in a nutshell. Heather described the microdata very well. In high affluent zip codes, spending dropped by about 20%. It didn't in other places. That 20% was largely spending at small businesses that employed low-income individuals. We will not get low-income individuals back to work unless we deal with that shortfall. Sending checks out to lower-income Americans will not deal with that shortfall. UI won't deal with that shortfall. You have to have another strategy, and that's what
is that. So you nailed the point that much better than I could. What's the strategy?
We don't have one right now. I'm encouraging you to make places safe to conduct commerce so that those individuals will return to their ways.
All right. Thank you, Doug. Thank you, Mr. Vice Chairman.
Thank you all very much. And I think, Doug, you did point out what the strategy is, which I think we all have at different times. It's to make it safe to go back to the restaurants. Rachel said very well, you can't force people to travel or to go shopping or to eat at restaurants. We have to invest in the healthcare, the science that makes that possible. Look, I want to thank all of you. You guys are wonderful. Our testifying economists outlasted the members of Congress, 4-3. So you win. Good work. And I want to thank all of you for a very lively discussion. It was very good to hear the yin and the yang on the automatic stabilizers. The important points about tying future Congress's hands versus making Congress react. I'm continually embarrassed that I went from being a car dealer with the 15% approval rating down to a member of Congress with 11, and wish that people thought better of our ability to handle all these different things. We really are upset with how much we've squandered in the early months. Jared's comments about the more than an order of magnitude higher rates of infection and death than we have I read in the Pantheon report, they don't expect the death rate to peak until the middle of August. And then Dr. Frist was on a fascinating call this morning. He said, as long as it's rearing up anywhere in the world, think India, think Brazil, it's going to come back and bite us again until we actually have the vaccines and the treatments necessary. So thank all of you. It is Congress's responsibility to somehow take care of the folks who don't have jobs to go back to and help them to get through. Let's take politics out of it. I'll continue to argue for a data-driven approach that ties assistance to the level of economic conditions. But I will also continue to worry about the debt. That's not irrelevant. And we will want to reduce uncertainty and restore confidence in our economy, in our government, and even in our Congress. So thank all of you for participating today. I believe the record automatically stays open for 3 days if you want to, after the Washington Post fact checks you and you want to correct the record, or me. And I really am grateful to all of you for being part of this. And we hope you will come back often. Good night. Have a great weekend. Thank you.